the start of the new tax year. So that's something to keep in mind for December 2020, I guess, at this point. And then throughout the year, if you want to lock in losses, it isn't clear if crypto is a security and if the wash rule applies. So again, consult your tax professional. But an aggressive approach may be to say you buy in Bitcoin at 10,000, the next day it goes down to 9,000, you sell it at 9,000, next day it goes back up to 10,000, you buy it back at 10,000. You've locked in. You could report a $1,000 loss on that one Bitcoin, and you still have it at a value of 10,000. Not tax advice, not trading advice. That is something some people think about doing. And then also realize that if you have tax losses and you don't have enough gains to offset them, say you have $2,000 of crypto gains in trading in a year, and you have $3,000 of tax losses in a year. The losses reduce the gains down to zero and then down to negative 1,000. So instead of having to pay taxes on your capital gains, you have $1,000 tax loss asset. You can keep that for a year to put towards other gains, or you can actually use it toward income tax. So if you have more than $3,000 of tax loss asset, you can put it toward this year's income tax and then just roll over the forward stuff. So that's tax loss harvesting. So forks and airdrops, again, this is a big point of contention. How do I, treat Bitcoin Cash, Bitcoin Gold, Bitcoin SV, all these? How do I treat all these, EOS airdrops, Ethereum airdrops? So the IRS says it's money, it's free money, it's an asset that was given to you, and so if you have control of that asset, if there was a liquid market, if there's a market price, then it was basically income that came to you, and you're going to owe taxes on that. Whether or not you want to recognize that airdrop, that fork, is up to you. There are a couple different ways that people have decided they're going to try to treat that. A lot of these coins become valueless very quickly, and so you don't really even have to recognize that you ever received those. But something like Bitcoin Cash was very liquid. It was valuable. It came out. It was worth $3,000 per coin, and there was a liquid market, and there was a market price, and so that's a tough case, and I don't think that one's been decided yet. But just something again to keep in mind. There's a lot of gray area in these spots, and you're just going to have to make some good decisions here. And our software helps you do that. It helps you see the implications of making your choices, and it allows you to work with a CPA to all look at the same coherent ledger. But a lot of issues come up where there's not a black and white answer in tax, unfortunately. But how you would account for any sort of income in crypto, whether it be mining, staking, airdrop, forks, is basically at time of receipt, you record the income, and then when you dispose of the coin, you sell it for another coin or you sell it out to fiat. You have a holding period, less than a year, more than a year, and you have a capital gain or a capital loss. So January 10th, you receive one XYZ token, it's worth $10. And on this day, you record income of $10 at the market value of 10. Less than a year later, December 31st, 2018, you sell that one token for $13. You now have a short-term capital gain of $3, which is 13 minus 10. So that's just how mining, staking, income, airdrops works. That's how it's accounted for in crypto. There's various other types of ways you can earn income in crypto. Interest-bearing, asset-backed programs like Celsius, BlockFi, Nexo, those types of things. You can earn it as a consultant. You can earn it working for an exchange, mining, staking, gifts. There's a lot of ways that it's not just capital gains, but it can be income. And so you just want to be constant for that. And our software will allow you to automatically tag that if needed. And then I just wanted to make sure everyone knows that you can contact us at zenledger.io, email us at flow@zenledger.io, and there's a discount code for you if you want to use it. And with that, let me know if you have any questions.
I'm sure the audience will have a lot of questions. Pat, you can hear me okay?
Yep.
All right. I'm adjusting the camera to show the audience to you. Can you tell me what, can you see everybody?
Yeah.
Okay, sure. So, thank you, by the way. I appreciate that. I know it was a little bit fast, and there was a lot of information packed into his
Sorry.
presentation. We have one speaker who still isn't here yet, and so her time is going to be divvied up among you guys if she doesn't show. So I think you may have plenty more time to talk. So I have a question for you. All right, you can see me, right? All right. So my first question is in regards to the forks. You did explain what the IRS demands that we do in the face of receiving forked coins, but do you have any understanding as to why they would have gone this route? To me, it doesn't seem to make any sense to have to register the price of a token that is part of a fork and then pay taxes on that coin when it may have been a coin I never even wanted in the first place, and it likely doesn't have any value the day that it was forked. So what does that mean?
Yeah, I mean, I do also agree that it feels overly burdensome and unfair. I think they basically just said like, hey, we're just going to treat that like a dividend, and you're going to pay taxes on it. And if that gets challenged or whatnot going forward, fine. If they address it in the future in a tax law, they may retroactively change policy, and then you can go refile your taxes and get a refund. But I don't think they spent a lot of time worrying about it and just kind of said, look, in our existing rubric, we're going to call an airdrop or a fork a dividend, and you're going to get taxed on it like dividend income today.
Okay. And by the way, just so you guys know, the audience is not being recorded through this thing, through the live stream. It's just so he can see who's talking to him. But I would like to know if there is anyone who does not want to be on the live stream or part of our recording. Is there anyone here, just raise your hand, who does not want to be a part of that? Otherwise, we can record you asking questions, which would be helpful. Doesn't look like there are any complaints here. So who else has some questions for Pat, either about Zen Ledger? Please. And
sure. So the question is about gifting crypto, for example, to family members or kids or whatnot. How is that treated?
Now, could you hear that, or do you want that?
Question, please, George.
Sure. So how is gifting crypto to family members or kids treated?
How is gifting crypto treated in taxes?
Yeah, so it is okay to gift crypto to family members or really anyone else. There are just limits. So I believe it's like, up to $10,000. It's kind of situation dependent, but you absolutely can gift crypto just like you could gift stocks, bonds, cash, car, any of those things. There's just limits to where then they have to pay income tax on that. You can also set up an IRA for somebody and put crypto into that for them.
How would the taxes be treated on that when it comes to capital gains? That's the question that I would have, because I would really suck to have to pay capital gains on a thing that I'm ultimately losing anyway. Right? That should be up to the person who receives it, not the person who gives it.
You can consult a tax professional, but you don't pay taxes on the capital gains. The person you're giving it to inherits it and the cost basis that you acquired it at.
Oh, okay. Well, that's good.
The gift back tax is always paid by the giver.
Okay.
That's a tradition.
Okay, that's good to hear. So, do you have a question? Yeah.
What happens when you withdraw Bitcoin from an offshore gambling site? And say that you brought it to a U.S. wallet or to an exchange. Say that you don't sell that, but you have a couple Bitcoins from offshore. How is that transaction treated in terms of IRS?
Yeah. So say you move it into Coinbase, right? And so the thing is that Coinbase is reporting activity to the IRS, and they will see that of the, say you have 2 Bitcoin that you bought with cash and 1 Bitcoin that you brought onshore from the gambling site. They'll see in their records that you spent and you purchased two Bitcoin on Coinbase with fiat connected with your credit card or your bank account. That's all KYC AML. And then they'll see 1 Bitcoin come in from nowhere And, don't be surprised if an IRS examiner says like, hey, you have to account for that. Where did that come from? Because it's on the public blockchain and it's on Coinbase's records.
Okay. We've got a question from Jeff here.
My question is, the Financial Action Task Force Committee, FAFSA, is going to be talking more about travel rules in the coming month or so.
Ugh. Ugh.
And,
Oh,
it's got a lot of people scared, of course. And I was wondering if you have any comments about the proposed changes and what we could reasonably see within a year and 5 years out.
Did you get?
Well, I think we're outside the bounds of what's reasonable around or what could be predicted or not predicted. I think what you'll see if there are obvious overreaches by, say, the U.S. Border Patrol, phones end up in court to be challenged. But in the interim, 6 months or a year that an aggressive policy is in place, like people did have to get detained or get access to their phones, even though they knew that that was an overly aggressive policy, right? So there's really, I don't know how big brother things are. I don't know if when our border patrol scans your face that it connects to all your assets and checks them anymore. I know that beagles are actually cash sniffing dogs. That's a little FYI for you. When a beagle walks by you in an airport, it's sniffing for cash that you're trying to launder out of the country. That's what they care about.
So your drugs are safe.
Yeah, your drugs are fine. Bugs, they're sniffing for dollars, which may be laced with.
They all are, I heard. There's a question here
Yeah,
too.
regarding the long-term capital gains, so let me make sure I understand it correctly. So if I buy, in February, I buy 1 Bitcoin, March I buy 5, and April, boy, they just jump up, But since I gotta wait a whole year to cash out on the first one that I bought, then the next one in February or March, I gotta wait again the whole year. So each time I gotta wait the full year for each time I purchase something and I want to cash out, I gotta wait a whole year. And that time thing can go up or down.
Capital gains are now tied to your income. So depending on the income level you report in that tax year, your capital gains rate will change. And some portion will be exempt, and then some portion will apply. It'll very much depend on your personal situation. There are various tiers of income that you would report to put you in different tax brackets, and that will put you in different tiers for your capital gains as well.
Well, that'd just be hard then because since it's so volatile, this thing is just going anywhere from, a high to a low throughout the whole year. And if within 6 months, you're like, yes, and then December or with your year rolls around like, I just lost it. So,
Yeah, we've shown, Bitcoin's shown to be incredibly volatile, right?
Yeah.
And so it's very hard to time the system, but I would recommend that a lot of people got stuck in a huge crash because of 2017 gains and then the 2018 crypto winter, where they owed a lot of cash that they did not have. So in 2017, if you're constantly flipping and getting into ICOs and making huge gains, but you keep doubling down, right? Your 5 Ethereum, becomes a 10 Ethereum becomes 100 Ethereum stack, right? But then in 2018, Ethereum goes down 95% and your ICO tokens go down 100%. You got left holding that bag. You still owe the cash consideration for the capital gains you made in 2017. You don't have any cash to pay for them in 2018, in which case you're probably going to have to work something out with the IRS and some sort of payment plan over time. And a lot of people found themselves in that situation.
got it. Okay, great, thanks.
All right. So we have one thing I want to mention. We have our tax attorney who did arrive, and that means that I hope that we can hold the tax law questions for her during her presentation or after her presentation. But I would like to ask if anyone has questions.
Yeah. So I think this might be a good time for me to sign off then.
Does anyone have a question about Zen Ledger itself, about the company, about what the product is?
Yeah, Give me more information.
Yeah, okay, so they'd like to hear a product pitch. All right.
So what Zenledger is it is a software that allows you to connect dozens of exchanges and wallets into one coherent ledger. We'll also track thousands of different coins. We'll track the price point of each coin. Even when it fractionates, you know how when you move one Bitcoin, it gets chopped up into like 10 different transactions. We'll track all that for you. We'll produce your tax documents for you. So Schedule D, 8949, we'll give you a full audit package. So your CPA can feel very comfortable with how we built everything, on how everything's flowing. And then, if an IRS examiner ever shows up, you'll have way more information than they will, because you will have tied everything together across many exchanges, many wallets, many coins over time. And then they'll just have a 1099K from one exchange that gives them a very incomplete picture of your trading. We'll also provide a full tax loss harvesting analysis for you, which will show you by lot, by exchange, by coin, where your coins are that you could sell at a loss today, to free up cash or to lock in a loss, and keep more crypto in the system in your investments by optimizing the amount of cash you pay in taxes. We also have great customer service, so you can get a hold of us anytime by chat, by phone, by email. We have like a very high net promoter score, tons of referral. One of our customers was the number 30 employee at Coinbase. He restated the last 5 years of taxes and found $250,000 he'd overpaid. So things help. Things like that help. So he's a good friend now. So things like that. So just some things to consider. So if you go to zenledger.io, use the SV Bitcoin 15 coupon, you get 15% off. If you buy multiple years, we can offer you a larger discount. Now is a good time to think about this because we're going into tax season. We can help you analyze your taxes now, and you can always defer, file an extension and file in October of 2020 as well. But we're here to just be there every step of the way for you. If you need a CPA referral, we can help you with that. We work with a great CPA out of Chicago, Andrew Gordon, his whole staff. They're fantastic as well. So just let us know if you have any more questions.
Thanks, Pat. One last thing. Were you still planning a giveaway, or is that not happening? To put you on the spot.
We are. So we do have a referral giveaway. I can't remember the particulars right now, but if you refer people to Zenledger, you can win up to 1 Bitcoin. And then there are several other smaller prizes as well. If you join our email list or create a free account, we'll send you an email about that giveaway contest.
We need to move on, but is your question quick?
I just want to ask, is on that, when you set it up, Zenledger, is that all the information downloaded from each of the exchanges to set that up?
Yeah, so
okay.
we connect by CSV or API, and it's read-only API. We never have any permissions to do anything. We only grab receiving addresses or CSVs. It's highly anonymized. You don't have to even really give us your email address. You could, but we would need that if we need to communicate with you. But you can use a Proton Mail. You can delete your account after you produce your tax reports if you want. Yeah, it's just. Does that answer your question?
Yeah. It does. Great. Thanks.
Thanks. I appreciate it, Pat. So now, let's see. Let me quit that. Well, that's meta. So now, so I'd like to ask Ben to take the stage. Ben Taylor is from SoftLedger, which is an accounting software for businesses, specifically individuals as well, or mostly businesses for crypto accounting, QuickBooks-like. So I'm going to hand this to you. Go ahead and put that on your zipper or whatever. I'll pull up your...
Can everyone hear me okay? This work? No? Not on.
Oh, no, it's not gonna be, it's not gonna be through the speaker. This is just for the live stream.
Oh, okay.
Yeah.
Oh, wait.
Good?
Yeah. Okay.
Okay.
All right. Yeah.
A world where crypto asset networks are kind of used widely. Trade is minor. A bit more. You're using this thing that needs to be tracked like a share of stock, like cash. And so it just gets complicated as you're doing that more and more. So if you have a bunch of transactions out of one wallet, they're all kind of the same, maybe it's not that bad, you can kind of code that. But if you have those and then you've issued your own coin, you're doing some trading, maybe you're mining, you've got some random airdrops or forks, then all of a sudden accumulating all that together and producing financial statements is really, really difficult. So then what happens when equity is tokenized widely and land is governed on blockchains and supply chains come into the mix? As these use cases take off, the accounting complexity compounds exponentially. So there's all these great things you can do with distributed ledgers and in transacting value in between different parties, but at the end of the day, like there's a lot of judgment that goes into actually getting that into financial statements. Even really seemingly simple processes like coding vendor invoices, you'd think that you'd be able to automate that. That's like something like a Bill.com does. If anyone could do it, it's a company like that processes so many of these. But still, I think the max accuracy you get is like 85% with OCR. There's still people involved making sure that these seemingly similar invoices just have subtle differences. So it's a very simple use case where it's not possible yet to automate this. So I suspect we'll get there eventually, but some of these more complicated things, if it's important for you to get your financials 100% right, or close to 100% right, humans will need you. Okay, so now on to the more practical side of things. This came from a talk that I gave, or a webinar that was very accounting focused, so that's kind of the area we're coming from, is like financial reporting people. So just keep that in mind going through this. I won't go into too many details, but if you have questions, obviously feel free to ask. So the first big use case for distributed ledgers is crypto assets or cryptocurrencies. And so an asset being digital doesn't really give you all the information you need for accounting purposes. Something like Bitcoin, maybe that's an intangible asset, maybe eventually it's cash. If you issue tokens as part of a fundraise, that would probably be equity or some sort of liability it could be, but something like that. And then if you trade it for a US dollar-backed stablecoin, then maybe that ends up being cash. It just depends on really the nature of the asset. And then on the reporting side of things, whether or not a network uses crypto assets as part of it or not, somehow that data still needs to get off of the blockchain and into financial statements. And so that part, there's additional enriching of data that needs to go into that is just judgmental, and there's just there's some human involvement in actually making that part happen. There's always going to be humans using software to make financial statements happen to some extent. So you just figuring out the mix of what you can automate versus not. And then of course, anyone dealing with crypto assets, of course, there's tax consequences. So like I said, it's like you're taking these assets that were either previously illiquid or less liquid, and now they can move around freely. They're kind of moving like cash, but they need to be tracked like shares of stock. So, you think about if you're gonna frequently trade stock, you might think about how much you want to do that because of the accounting headache at year end. If you're continually paying for expenses with Bitcoin, you might have the same type of headache at the end of the year. Of course, that bill in front of Congress, maybe that makes it easier certainly for buying a cup of coffee. It seems like if that got passed, that would be an issue. But if you're a business, you still need to track to say, okay, these are under $200 or whatever the case is, and say that, okay, I don't need to report on those. So from an accounting standpoint, some of the same requirements still exist. But of course, for verification of responsibility, this is really exciting, is that you can have this immutable transaction where you know when it happened, you know who the addresses belong to, you know who's involved, and then what it was as well. So if you're not an investment company, how crypto assets are classified is under intangible assets for US GAAP. And this is kind of a catch-all for things that aren't really called out specifically elsewhere. What it means is they're valued at the book value, and you mark them down if there's impairment, it's called. So like if there's some reason for you to think that the asset was impaired, you'll bring it down, but you won't do the same thing on the other side. It's kind of like a conservative approach where you want to show that it went down, but not come up with a reason to true it up. And then
Ben, I just want to give you a different microphone. That one seemed to cut out, and I want to make sure that the live stream is getting you. Otherwise, your friends at home will be very upset.
And Ben, interrupting, can I actually ask you a question?
Sure.
Can you please tell us under what authority have we determined that intangible asset is about for accounting purposes?
Oh, also,
What do we look to?
I meant to leverage Pat's disclaimer too, that
Yeah.
none of this is,
Yeah.
we're staying in the software provider category.
Yeah.
That was, none of the, I don't think anything was explicitly said. This is just kind of like where it seems like they'd fall. I think there might have been some letter
There
or
was a little bit of guidance, right?
Yeah.
FASB or whatever.
Yeah, and it seems like when you go through the thought process of where it would land, it's tough to make an argument that it would be somewhere else, but it is still kind of a catch-all. It's not specifically designed for these. And then if you're an investment company, there's a whole separate section that governs what that would look like, and probably lands in the similar category to securities or are they hearing me now? Is it good? Okay. Or whatever classification they end up being in. And then I wanted to touch on, as it relates to fiat currencies involved, one of the complications is, when you're buying a share of stock or you're buying call options or some other financial instrument, you're paying cash and the price is the price. But with crypto, there's a whole bunch of exchanges all over the world operating all the time, and it's, some are pegged to Tether, some are actually pegged to dollars. You just don't know really. And so it's tough to determine what that price is. And then the crypto side of things, it's when you're trying to price these, it's what do you use specific exchange prices? Do you use a weighted average for a bunch of different exchanges? You have things like how in South Korea the prices are much higher. That can really throw things out of whack. So if you're doing an arbitrage in a bunch of different exchanges, you probably can't use an average. But for most companies, if you're not doing that, we see a lot of our customers ends up using the weighted average of the top 10 exchanges daily, and that we still don't know, but so far that seemed to be okay. This question's come up whether like an open ledger like a blockchain-based network could be a general ledger. So could your accounting come directly off that? It's impossible to predict the future, but as it stands today, it's unclear why a distributed ledger would be better than a centralized ledger when it comes to a company's internal records. On top of the clear privacy issues with just throwing your data out there and be concerned if someone else would see it, there's a lot that goes into, like we were talking about, a lot that goes into actually taking the data, enriching it, and then turning into a useful format so that it's actually useful to the external stakeholders. So yeah, at this time, it seems like that's the best use case for it right now from a accounting and financial reporting standpoint would be as like a mechanism for actually reporting the data. So you could map your general ledger accounts or whatever to however that should show up on this reporting module, and then it could just be displayed and be available to the public. Maybe that could be a more efficient and accurate process, but it will take some work to get there. And part of that is internal controls. So you can automate some of this stuff, but the same requirements exist. So that's just something to consider as well, is just how do the controls work between your wherever your records live and actually getting stamped on this blockchain, because it's similar to filing with the SEC. Once you put something out there, then it's done. Your mistake is memorialized forever. So that's something to be careful of as well. And of course, ease of interoperability and syncing between these is really important, because if it takes the same number of steps, it's just not necessarily a better solution. And so for companies functioning as an exchange in the U.S., there are certain requirements they have to give their customers so that they can do their taxes. It depends what that is. The reporting functionality right now isn't super robust for a lot of exchanges, and especially if you're transferring between them, your cost layers don't necessarily provide a tool to track what your your cost layer was from one exchange to another. So if you want to track those, it's tricky. You need to kind of match them up. And then, of course, in the U.S., gains are taxed in dollars. Not a shocker there, but what that ends up being is if you were doing transactions at the top of the crypto market and you have these realized gains sitting out there, then all of a sudden you come to today and maybe your assets are worth a lot less. You still have this tax obligation, but you don't have the assets. So that's just something where I feel like that caught some people by surprise, and it's just something to think about as these swing wildly, especially if you're a business engaged in a lot of crypto transactions. So for U.S. regulations, so far, there's been some additional clarity, just like teasing out some things like the intangible assets. But the IRS still, it's they're treated as property. That hasn't been updated a ton. There's been some clarification, but it seems like if you're a business, first in, first out is probably going to be the way that these are treated. Again, if you can specifically identify two different trades you got some Bitcoin and then you use that Bitcoin to buy another asset on behalf of a client, maybe those two things go together. It wouldn't make sense necessarily to bring your cost basis in Bitcoin from like 2 years ago for that transaction. So I could see that argument making sense. But so far,
Wouldn't it depend on the tax? Oh, sorry, not the tax rate. Your holding strategy as per a company, right? If you're just doing crypto payments, first in, first out makes sense.
Mm.
But if you're investing, first in, first out may not be.
yeah, but it's there's not a lot of clarity, but based on everyone who we've talked to about this as it relates to doing this as a business, it seems like for that very reason, the same reason you'd want to use last in, first out is the reason that you can't, is kind of what it seems like is, the consistency is definitely important, like Pat was saying, but that's what we've heard so far is that would fall in line with how some securities costing would be, and that seems like first in, first out in most cases. And then for non-U.S. Jurisdictions, some things changed, like Canada and China widely use weighted average. And then in Malta and Singapore, there's no long-term capital gains tax. So of course that applies to crypto as well. So we're kind of hearing the different jurisdictions, how they're weighing down on these things as we go. We end up having customers all over the world, so it's interesting to see what's the same and what's not, and kind of how everyone's approaching this.
And then just to circle back, I looked it up. It's actually IFRS guidance, so not U.S. GAAP guidance on the intangible asset.
Oh, really? Okay.
But it's worth noting that almost a really wide number of countries use IFRS. The U.S. using GAAP is like an outlier. Mm-hmm. So that means that we're probably going to follow IFRS until we know better, right? I think that's kind of where people are landing.
It depends. I mean, I guess on that one we probably did, because I think it was, we ended up, I thought the thing I saw ended up being U.S. GAAP, but I mean there's U.S. GAAP, and then there's a bunch of GAAPs in Europe, and then there's IFRS that some people, and then there's different forms. It's tough to get everyone on the same page with this, but I guess maybe intangible access is a catch-all across all of them. There's just a couple things I want to touch on here, and then I'll open up the floor for questions. As it relates to asset verification for supply chains, that's something that we think is pretty interesting, is this idea of having an asset go from manufacturer through various distribution steps all the way to a customer. That you could choose who has access to that information, and it might help for auditing, and you could see where everything is at as it changes ownership as well, if there's complex ownership structures. And then to assess outstanding liabilities or creditworthiness, having some of this data be more public-facing, it could help businesses assess who to do business with. So that's all I had. I have a raffle giveaway, and I forgot what we agreed to, but I can send that out after.
So he's giving away something. He doesn't remember what he's giving away. I think he said it was his car. Is that right? Your house or your car? Which one was it? I don't know.
It was my. I don't have a car, so it's the car.
Anyway, I guess the point is that there will be a giveaway, and the way to do this, I'll do it at the end of questions. All right?
Okay.
How about that? So
I think it was a certain period of time of free subscriptions.
Yeah.
Okay.
It was like a year or something of free subscription.
Okay. Anyway.
To a lucky winner. But let's take some questions right now.
Okay.
Anything about?
Yep.
I'm confused, and forgive my stupidity, but classically, when I think of intangible assets, I think of a patent,
Mhm.
as an example. Now, the prior speaker reminded us that crypto is actually considered more like an equity,
Mhm.
like a stock or a bond or another asset. So, can you maybe bridge that chasm for us?
It's to do with like it could be equity in a if you're basically issuing tokens that should correspond with ownership in your company, that would probably fall into the category of equity. But if it's just this thing that you have that has some value associated with it, and it's unclear whether it, there's no useful life, so it doesn't like depreciate over a certain period of time, so that might fall into like something that would be amortized or depreciated. It's just kind of that's why I talk about being a catch-all. Is it's not really what you'd think about as an intangible asset, but it really doesn't. If it's not equity, if it's not clearly a liability, if it's not an investment, it just kind of that's where it sits.
So in the crypto space, maybe give some specific examples of that difference. So Bitcoin would be tangible, or like an equity. What would be intangible?
I can't say. Sorry? It seems like it. Sorry. Oh, okay. So you asked if a CryptoKitty would be intangible or Bitcoin. Based on that definition, I would think so. Either of those. At this point, I don't know. I think that really depends on the specific situation, but that, as far as I understand it, that's where they would fall, unless there's, for each of those, I don't think there'd be another one that would make sense. Yep.
Where do you integrate with companies? Like, what's the handoff point between your product and the company's like internal accounting and compliance functions?
Well, we are the core accounting system for the company. Okay. So for some of our customers, we end up integrating with their platform. So we have like ATM providers and crypto exchanges that send us transactions. It depends on the industry company.
So their consumers might actually see your product directly, or the output directly, not necessarily.
They might see the output. Yep.
Do we make distinguish between Bitcoin and Ethereum on one side and other tokens on another side, or you consider them the same?
Under this logic, so the question was, would you distinguish between Bitcoin, Ethereum, and then other tokens, or would they all be considered the same? The accounting framework kind of, they would be probably considered the same, something like that. There wouldn't be a clear distinction from like a financial reporting perspective, usually. I think it would be more to do if you were issuing an ERC-20 token as part of a fundraise, maybe that's different to you. But if to a holder of it, it might be the same as Ethereum.
You don't distinguish. It's all the same for you. In your
Yeah, if you're just holding it as you're not affiliated with it, probably.
So you don't follow the rules of SEC that Bitcoin and Ethereum are money. Recommendation from SEC that Bitcoin and Ethereum are money, or the rest is security.
Oh, so that's not that hasn't been issued as like authoritative guidance for when you're creating financial statements. They've just kind of hinted that they fall in that category, but this is more like if you were a public company and you're coming up with a financial statement and you're saying like, what line does it fall under? Right now, it probably wouldn't fall under cash until something changes.
This is going down to your concept of the software. If it's going one way or another way.
You have the option to do it, to record it wherever you want.
So essentially everything now is a kind of security.
It depends. It could be a security. It could be intangible asset. You could record it as cash if you wanted to.
Do you differentiate liquidity between tokens? Like something is more liquid, another is less liquid, as a typical asset? I don't know.
I think that we don't distinguish. That might come into play to determine where it's categorized. But yeah, that's not something we've gotten into.
Thank you.
Sure.
Any other questions? Okay, so here's the way the giveaway is going to work. He is going to think of a number between 1 and 100. You got your number?
Yeah.
48? No? Good. Okay, so it's not 48. All right. And if you'd like to be a recipient or a winner of what he's going to be giving away, which is a certain amount of time as a subscriber for free, please raise your hand and venture a guess. And if it's within 10, plus or minus 5, right, then you are the winner. First person to get it within plus or minus 5. Now, who do you want to? Are there really only 3 people who want to get free stuff?
It was 67. That's good. Wow. Yeah. Oh. Damn it.
You snooze, you lose.
I'm sorry that.
Okay. Here, let me grab the
Okay.
mic for a second. I'm glad we got it working.
Yeah.
Again.
Thanks. Thanks, everyone.
All right. So guys, we've been sitting for a while. I'd like everyone to just stand and stretch, right? Let's get invigorated. And if you haven't gotten a beer, there's tons of beers left. I'm shocked. There's no pizza, but there's lots of beers left. Like that to me, I'm yeah. See, go get them. All right. So let's just take a minute to stretch. Put your arms over your head. All right. Let's get the blood flowing. And then I have a really weird exercise that actually seems to work to wake you up a little bit. And this is going to look funny, but if you take your ears and you yank on them, like, I promise I'm not trolling you. I promise that, okay? All right, you yank your ears and you'll actually find that your blood flow is going to your head and you'll be awake after a few minutes.
Sure, this is like botany do.
Yeah. All right. Or pop an Adderall if you need to. I don't know. So while you guys are doing that, I'm going to put this up on the screen real quick. This is kind of funny to me.
Sure. You know if Ben will be sharing his slides from his first talk?
Everybody can share. Yeah. Is it all right if we share the speaker's slides? Ben, you okay with sharing? Yeah. I mean, it'll be part of the recorded video anyway. Yeah. You sent me a version.
Also could hook up.
So
what type of
the reason, so we're actually recording the screen, and the way we're recording the screen is through here.
Okay, let me send you a slightly different version then. Only
Okay.
Because
Yeah. Send it to me real quick.
I changed like one word.
No, it's fine.
While I was sitting there.
All right. So guys, I want to show you something real quick while Alice is sending me her updated thing. This is an old meme that you guys may have seen before, and it ultimately was really clever to me. For a long time, it really resonated with me, because when Bitcoin hits $1 million, think about that, right? So people ask me, hey, when are you going to sell out? When are you going to sell, right? Is it 100K? Is it 150K? Is it? So if Bitcoin, in my mind, if Bitcoin hits 500,000 or higher, I will continue to buy more,
because that makes me scared of fiat and every other money that's out there. I will not sell when it hits 500, but I'll probably sell some when it hits 100. All right. But I find this interesting when it comes to the IRS, because I think the IRS understands this technology, actually yanks the control out of their hands to be able to force taxes to be paid. They could, however, be doing something very clever by creating a payments network where the taxes actually get baked into the smart contracts within the payment network. If they were clever, they would do something like that. But in any case, I've always... Right. Right. So, yeah. I know what you... I mean, there are tons of things we can do with tax dreams, right? But the IRS still hasn't gotten it right when it comes to what to do. My hope was that I could do LIFO, which is last in, first out, and we can't. I'm sorry, not last. First in... LIFO. So last in, first out. I was hoping that we'd be able to do something like that because eventually my first Bitcoin that I got for $70, maybe the IRS will have died by the time that I have to pay taxes on that. Maybe I won't ever have to pay taxes on those first coins if I use some type of tax strategy, which is why I go back to this. But anyway, I digress. Guys, can you please be quiet because I'm going to be asking our next speaker to come to the stage.
If we could all come back in, if we could all pull it back in. Hey, Ed. Come on, George.
All right, guys. I'd like to ask Alice to take the stage. Alice is our tax attorney. She works with Perkins Coie, and she has been doing crypto taxes for ever since probably before I bought my first Bitcoin. I mean, before 2013, was that your first?
Yeah,
2013
that's when I finished
I don't think I know of any other crypto tax accountant than she who has been in this game longer. So you guys really have a treat. All right, which means that you need to be quiet so that way you can enjoy your treat.
So I need
Alice?
the device.
Yeah, you can just clip that to your shirt. And,
Okay. How close to my?
you can put it right in the front. Just clip, it doesn't have to be on the
Okay.
yeah, it's better down there. Yeah.
I was figuring that. I don't want to sound really strange.
Okay. Now let me get this off and then get your thing up.
All right, so while he's getting my slides up, I actually have been here before, but I was actually in front of the Silicon Valley FinTech meetup. Slightly different crowd. I don't know if any of you guys were there. I presented with an economist. Anyways, I don't recognize any faces, but this is an amazing turnout for a bear market, so I'm really impressed. For taxes, and so I'm really glad that I was invited, and thank you, George. It's also unfortunately I don't think I have a giveaway. Oh, I recognize you in the green sweater. You were at that, I think there, maybe. Yes. Okay. Cool.
She's being modest. She's the grandniece of not one but 2 Nobel laureates in physics.
Yeah. Yeah. Well, so I'm a disappointment as a tax attorney. But yeah, we have some scientists in my family.
You did email it?
Just use the old one. It's fine.
Okay.
Yeah. I may have closed my computer too fast. But it doesn't matter. I added a sentence that I'll just say out loud. But anyways, so for better or for worse, I've been making presentations about Bitcoin and taxes since 2013. And I guess the hardest thing for me is knowing the audience. And so what my presentation is intended to do is give a framework that's basic enough for us all to be on the same page. And then I really would prefer if we could have a substantial questions and answer session. And one of the reasons for that is I don't typically know in advance whether my crowd is generally investor focused, individuals or if they're operating businesses in the crypto market. And so just before I get started, maybe I could take a quick show of hands. Who's interested from the perspective as an individual investor? Okay, and then who's interested from the perspective of running a company that owns crypto assets or transacts in them? It's usually a smaller group. Okay, not you? Okay. That's my husband, he runs a crypto company. Anyways, okay. So I thought it might be helpful if we talked about all the new guidance. So that's the focus of my presentation. I have to give some disclaimers. I'm a lawyer, so that's where I start. The disclaimer that I added that didn't come through on the email was that I'm not here representing Perkins Coie. In fact, I didn't ask for permission to be here. I didn't talk to any partners at the firm. I'm just here as, this is a hobby for me. This is something I like to talk about. We don't do a substantial amount of crypto tax work at Perkins, even though we're one of the bigger crypto firms. Our tax practice is probably less than 10% crypto at this point in terms of, hours. So, anyways, one of the critical points I want to say here is I'm not providing legal advice because I don't know your individual facts. I'm also not providing investment advice. That means I really want to be clear. I'm not endorsing any of these assets as investment classes. And then if we have questions and answers and you really want to ask me a question that's very specific to you, let's play the game where you say hypothetically, and then state your facts so that we're not, first of all, if you're disclosing your personal, tax situation, that's sort of not necessarily the best idea. And then secondly, I don't necessarily want to get into a very personal back and forth where we're talking about tax advice for you. So if you please stick to hypotheticals, that'd be great. Okay. Sorry, so many disclaimers. So what guidance do we have? We have 3 pieces of guidance. Notice 2014-21, which came out in March, just in time for everyone to file their taxes in April. I think it was also the second half of March. And it gave us some information, right? It wasn't really news to me, but it was news to a lot of people. Most people were very surprised by Notice 2014-21. And it's a Q&A, and it says, what the tax classification of virtual currency is, and it's very specific. It only talks about convertible virtual currency. Then it sort of runs through the basics of how the tax system works. It talks about property for property exchanges, property for services exchanges, why those events are taxable. It talks about the basics of character and the basics of information reporting and backup withholding. What's important about the notice is it really doesn't say anything that changes the existing tax system to conform with this new asset class. And that was obviously the big complaint in 2014 when this came out. Everyone wanted to do something different, and really it just said, well, the system already is set up to accommodate cryptocurrency, so just read the tax laws, stupid. So then we got, a nice break for a while, and we finally got some more guidance 5 years later in Revenue Ruling 2019-24. Now, that came out last October. I don't know if you all saw it. It really got some coverage for being, a pretty definitive statement on how the IRS proposes to treat hard forks. And some semantic issues aside, it said pretty clearly that there's a situation where hard forks result in ordinary income, i.e., the fork occurs, the new Bitcoin Cash or whatever you receive is in your Bitcoin Cash wallet, and as of that moment, the value of the Bitcoin Cash is ordinary income to you. I will cover this issue in more detail if that's upsetting news. I promise. Okay. And then October 9, 2019, they also issued updated FAQs. So instead of the form of a notice, we got another set of much more lengthy, much more sophisticated FAQs. And I would say, from my perspective, the FAQs are great because they actually represent that the IRS has thought about it, studied it, learned that it's different in a lot of ways from what we're used to, and has actually designed somewhat of like a custom set of thoughts around cryptocurrency. You know, they try to understand the technology in a really genuine way, and it's clear through the facts, the FAQs. So I called out 3 specific areas that I personally believe the FAQs changed something that I previously thought. So in Notice 2014-21, for example, the valuation was to occur on a specific date. So let's say you traded between Bitcoin and Ethereum and you wanted to determine the value of the Bitcoin that you sold in that exchange. You, under 2014-21, would be perfectly comfortable using the average price during a certain day. In the FAQs, they specifically say that you have to think about the exact time that an event is recorded on the ledger. Now, that's a fun practical problem, so we'll talk about that in a minute. They also said worldwide indices. I have to tell you, my advice to my clients up until that publication was that non-US exchanges are probably not abiding by US laws, and therefore their prices are unreliable. Now, that's really important. It's very important for people who are transacting in December 2017 because a lot of the price inflation occurred on other foreign exchanges. So where you priced your Bitcoin would heavily influence how much phantom gain you had under the scenario that both Ben and Pat talked about. So worldwide indices means that they actually want you to use the Korean exchange that has an inflationary value on something one day and then not the next, which to me, we'll talk about that. Do you have to do it that way? Is this a mandatory approach? And then finally, and most excitingly, they got into how you deal with basis and the FIFO, the pools of basis and how you attribute them to the Bitcoin that you sell. And I think both Pat and Ben talked about this briefly. The accounting rules are different. I just want to be clear. Tax and accounting don't really match on this. And they talked about specific identification and gave a really clear sign that they were going to accept specific identification as a mechanism. And I thought that was pretty groundbreaking because it wasn't clear before that you weren't stuck with something called average basis, which is the worst case scenario. Okay, so that's like my quick lightning summary of them. And we can go back and talk about each of these topics a bit more. But I want to give you the most important note, which is, okay, the IRS said all these things. Do we have to listen to them? And so outside of law practice, and also probably outside of the CPA profession, you probably think that if the IRS says something, it's true. It has to be true. It's binding. Because most of the time, most people comply with their taxes by doing exactly what they're told, right? What happens in an area that's new, like cryptocurrency, is you get a lot of gray areas. And you get a lot of areas where we're still learning how the rules might work. So it's not like filing your tax return with a W-2 or just entering your details from your 1099. In fact, there's a lot of positions that you might take on your tax return that would be different from the position that the next person might take, or the IRS. So that's critical. You can disagree with the IRS. So when we start from that standpoint, how much can you disagree with the IRS is 90% of my job. So what that means is, let's say the IRS is, let's say there's a range of positions. The IRS's position, your position, Daschle Shapiro's position, publication that EY put together has a position. There's a bunch of different positions. Which one do you pick when you file your tax return? And the answer is you have to have something called a reasonable basis for taking a position on your return. If you don't even have a reasonable basis, you are under threat of severe penalties. However, you don't have to be certain. You don't have to be 100% sure that your position is correct. So if, let's say, you're like the IRS one sounds okay, it sounds like it's 60% correct, but there's some issues with it, and then the EY position's like, okay, 30% correct, but it gives a really good result, right? You can go for that one because 30% is actually sufficient. It is actually, people think in terms of percentages, it exceeds reasonable basis. And the measuring point is whether there is actually authority. And the fun part about cryptocurrency is there is no authority. And the publication of Notice 2014-21 or Revenue Ruling 2019-24 didn't really change the amount of authority out there because authority is law. These are regulatory publications. I mean, revenue rulings are wonderful, and we often use them as much as we can when they're beneficial to the taxpayer. But what's law? What Congress, if it's in a regulation, maybe that's law. What Congress enacts, what a judge decides, those are laws. So these are not binding, and they're not authority, and so you're left with a great big free reign. And my friend Dashel says this is the easiest area of law to practice because there's no rules. So he'll probably be a good person to hire if you're looking to be audited later. But anyway, so long story short, within a day of Revenue Ruling 2019-24 coming out, well, let me take it back a second. Do you understand why 2019-24 is so traumatic? A lot of people received Bitcoin Cash, and it was very valuable when they received it. It's even worse if you received it as a holder on Coinbase, because you received it after it accumulated a lot of market value. There is a question of whether it had any value at the exact instant the fork occurred. There was trading, but it didn't occur that very second. At that very second, the price was question mark. Yeah, so the best thing you can do with 2019-24 is to say the value was zero. Sure, yeah, I had ordinary income. I had zero ordinary income. That was the value. But if you were a Coinbase user, as I'm sure many people in this room are, you would be holding it, receiving it at a moment when it would be incredibly valuable. And so it's a very large tax expense with very little liquidity. So it's a bad answer. There are tax theories cited by the IRS in the revenue ruling case law, good case law, that they are saying substantiates their position that it's ordinary income at the time that you receive the forked coin. But I mean, practitioners are already coming up with arguments, case law, positions that take a different view. And the general gist of the theory is, well, if you have a cherry tree and it grows cherries, you didn't have income until you sold those cherries at the market. So there's a completely different construct from the IRS's construct, which is, I guess, the windfall construct. Like if you catch a baseball at a baseball game, that baseball is income to you. So the IRS used that theory, but you could also argue the cherry tree theory. And if you look at that compared to the IRS's arguments, who knows? Maybe it's 50-50 who's right or wrong. So what position do you want to take on your tax return? I mean, if you take the revenue ruling position, you're safe, right? But if you want to not take it, you can probably take a position that it's reasonable to take a different position in your tax return. In fact, many people have to do that because they already did. But there's another alternative if you're sort of someone in the middle. You don't want to be super aggressive, but you certainly don't want to overpay your taxes. And that solution is disclosure. So you add a disclosure statement to your tax return that says, I'm not going to file consistent with Revenue Ruling 2019-24. talented CPAs can draft these disclosure statements for you. They're pretty much, it's not like, obviously you're putting the IRS on notice and saying, audit me, but at the end of the day, like, CPAs prepare these all the time. Large corporations have several on their returns. It's something that you should consider. And in the event you get audited, yes, you might have to pay tax. Yes, you might have to pay interest. But you've greatly reduced your risk of penalties. So it's probably worth it, aside from the tax attorney fees. But that's, yeah. Anyway, FAQs, as much as I love the FAQs and how much insight they give, they are not even necessarily a protection for you. So the reason for that is if you ever went and got, like, someone took a position that, your tax return position was wrong, and you went to tax court, can you imagine with a straight face saying, I reasonably relied on this, and then pulling a download from the IRS website that was, published as an FAQ at one moment in time? It's very difficult for a tax court judge to say, oh yes, I recognize that as something that you can rely on, that you reasonably relied on to take a tax position. No, you need more than that. There's a lot of written documentation on the IRS website, and they would be very fast to disclaim it if they needed to. So I don't know. I mean, I would like to hear what my other tax colleagues have to say on this, but I think it's difficult to rely on the FAQs yourself. And so certainly the IRS, if they've got something favorable to point to in the FAQs, it doesn't give them any extra, strength in their position. So what's critical about all of this is, right, so I said we have no law. This guidance isn't worth very much. There's a lot of gray area, and what's going on really out there is that practitioners are all having constant conversations. So I talk to the guys at Deloitte. I say, okay, so how are you dealing with this LIFO stuff? And they say, oh yeah, this is our view. And I'm like, oh, but like, what if we just like push the envelope a little harder and we took this aggressive position? And they're like, oh yeah, we're nervous. We don't like that. So we talk to each other all the time, like about how we feel about different positions, and we're all basically building like our own body of like what we think is a reasonable position amongst ourselves. And that's the best we have right now, because if we wait for the IRS, no one can file their taxes. And I don't think most tax attorneys are used to being able to cite law for why they're taking a position. And since we can't do that, the second best thing we have is trust in our colleagues, other attorneys. So it's definitely how I try to think through issues myself. So I actually think I might be going a little bit too slowly here. I apologize. There's a lot of outstanding questions. You might think this is boring to still see like-kind exchange on my slides, 2020, but the IRS is actually auditing returns with like-kind exchanges on them and hasn't decided what it's going to do. It has taken them, I think they've been on hold for like a year with these returns. What that means is that it's probably a reasonable position. The longer it takes the IRS to figure out whether it agrees with like-kind exchange, the more likely it is that it was a reasonable position in the first place. And it affects everything. People can file amended returns and take a like-kind exchange position and apply for a refund. They don't have much more time because you only have 3 years from the due date for your taxes to get the refund. But and it's hard to get big refunds out of the IRS, but it's still relevant. The Ethereum fork. Okay, we had this 2019-24 guidance. What about the 2016 Ethereum fork? I personally think there's a strong argument that the Ethereum fork should not be treated like Bitcoin Cash. No one calls Ethereum Classic Ethereum, right? So there's a big question. I mean, compliance, people are still struggling with compliance issues. 1099-Bs, I think there are exchanges that are beginning to decide just to file them. You may get some in the next few weeks.
Classification issues. This is just a rumor, by the way. I don't advise exchanges on 1099Bs. Classification issues remain. We have more and more exotic products being designed every day. Staking tokens, really fun to discuss. Decentralized finance contracts. Don't trust what these companies are saying about their DeFi products. They're not getting advice yet. Seek your own tax advice. Marketing materials that talk about tax features are very problematic. And then property loans, MakerDAO, similar contracts like that. I get into arguments, very deep, interesting arguments, metaphysical arguments about whether a loan of property is really a loan with other tax practitioners. There's some fun stuff that's open on compensation. 409A, you can't issue options on an asset class unless it qualifies for a 409A exemption, realistically. And it's not clear that 409A would apply to compensatory options issued with respect to cryptocurrency. They'd have to be classified as commodity, I believe, in order to even start qualifying. And then there's all these nuanced issues around 83Bs. And then I don't know if I have time to talk about this, but should I?
Yes, unless someone needs to leave, you guys can walk out. But
wait, what was my time? Isn't there like a lightning thing that's supposed to happen?
Yeah.
Okay. Okay, I have I've been ranting about this for a while. I actually had an interview in 2015 for a job I got in 2015 where I ranted at the partner about this. So I don't know how she still gave me the job. But anyway, so okay, what's the Coin Center legislation? What am I talking about? They've reintroduced a bill that they've introduced a few times. I think this is the third round, that would exempt transactions under $200 with cryptocurrency from taxation under certain narrow circumstances. My biggest issue with this is I think these are people who are lobbyists trying to get paid, trying to look like they're doing some lobbying, but not actually getting a lot of good advice about what would be successful and what would be meaningful for taxpayers. So I feel like it's a bit of a gimmick to run with this legislation for a third time. You may have seen it before when it had an exemption level of 600. Now it's 200. And now it's standalone. They got rid of a bunch of other crap that they had attached to it. But essentially what it plays off of is a Code Section 988E exemption that has existed for a long time for foreign currency. And the way 988E is designed, individuals who, let's say, went to Mexico in 2005 and kept a bunch of pesos and forgot about them, and then decided to go to Mexico this year and spent those pesos, they had without this exemption, they would have had a tax event. I think, based on what I looked at, they would be experiencing a tax loss. And the reason for that is that the peso against the US dollar has gone down in value, and so when they spend it, they're not spending dollars, they're spending currency. And under basic tax rules, currency is taxed as if it's property, just like you think of how Bitcoin is taxed. And companies that transact in a lot of foreign currency recognize gain or loss as they transact with those foreign currencies. So what they have is they have something called a functional currency, which is usually the US dollar, that they designate as their measurement point. And anything other than that functional currency is measured as gain or loss. So obviously the IRS cannot police tax compliance with respect to the pesos that you forgot in 2005. That is not an objective that the tax code has. Generally, currencies fluctuate both up and down. The US dollar has been strong, is generally down. And generally speaking, the IRS would be experiencing lots of tiny losses on lots of returns filed by unsophisticated taxpayers. So 988E is a very narrow exemption, and I wanted to put it up here only because I want people to see how narrow it is. Okay, so first you have to be an individual. Okay, that doesn't work if you're running a business. Secondly, it requires you to be transacting in non-functional currency. So if you exclusively transact in a particular currency, or arguably Bitcoin, it shouldn't qualify for this rule. There's another tax treatment of it. So non-functional currency, and it has to be a personal transaction. And this is really the key. So then you get an exemption unless if the gain is less than 200. So personal transaction just means, okay, it's not a 162 expense, so that's a business. That's business. Okay, we already talked about that, right? You're not allowed to use it for your business expenses. What's the logic there? You don't want to have someone experience income and then and exclude it and then take a deduction, right? Because then they get a double benefit. So the heart of it is in the definition of expenses under 212. So 212 is a provision that really tries to take the deductions that are available for businesses and says investors get these deductions too. It defines what an investment is. And of course, taxpayers for many years have been pushing that boundary as big as it can be. Like the definition of what an investment is everything except for your primary home, basically. And so anything that might produce income for you. And here, this is the problem. Who isn't transacting with Bitcoin other than with the goal of getting income? Anyone? Is anyone transacting in Bitcoin without the goal of making income, making a profit?
Like buying things with it? Just...
No, yeah, are you just holding it and not expecting for it to go up in value?
A little bit.
Yeah, you're hoping that it goes up in value, right? Like how could you not? And this is why.
Converting currency. Let's
Huh?
say you're trying to move money out of China.
Well,
You're using it as a conduit currency.
when you're doing that, then the gains and losses are small anyway, so people aren't.
Oh, sure.
I mean, I don't think that's what people are focused on. But that is a good point. There are people who are using it for liquidity and movement, and I think that's a non-U.S. issue mostly. But I think that's a really good argument. Anything else? Did someone have anything else? No? Okay. Well, I put some pictures. This is the Bitcoin price, right? Somewhere back here is when I got my first Bitcoin, I guess 2013. And then it went up, and then it went down, and then it went up. This is actually the price of a peso over a similar period. And if you look at it side by side, like there's a very remarkable difference in the two. And one of the critical differences is like the range, right? Volatility inherently creates investment value. So my view is that you're going to face an uphill battle if you were ever audited after taking a position under the new version of 988E to persuade the IRS that this was truly a personal transaction. Because under what universe would you be transacting with this asset instead of this asset? You know, just except for to make money. You know, I mean, it's just very hard to plausibly argue that. I think there are arguments. There's fringe arguments. There's a world in which we might actually start using them for coffee. But currently, in today's day and age, I don't think this exemption would provide any real value to taxpayers, as well-intentioned as it might be. So anyways, so that's my rant. And with that, I actually hope that there's still time for questions. Okay, all right, go ahead.
So I'm not expecting to predict the tax law 30 years from now, but hypothetically, kind of alluding to George's point earlier, if someone were to hold and theoretically never sell, maybe 20, 30 years from now, you want to buy a coffee, you want to buy some groceries, do you think that would be considered, as of today, a taxable event? If you're not buying an altcoin, you're not buying, you're not converting to fiat, you're just buying groceries for a coffee. Would that be it?
Yeah, the tax law doesn't care what it is. They just place a value on property. You know, It's called, well, I get told off by some people in the tax bar for using this term, but it's like a barter transaction. Basically, if you ever went and said like to your buddy, like, hey, I'll provide you some coding services if you cut my hair, and like that transaction, although it happens informally all the time, has always been a taxable event. And no one really thinks about those events because we use cash so fluidly now. But any kind of transaction between property of value, doesn't matter what it is, would be taxable. It's viewed as two separate cash transactions. So what you're taxed on both sides of the exchange. The seller of the groceries recognizes income as if they sold the groceries for cash, and the seller of the Bitcoin recognizes income as if they sold the Bitcoin for cash.
So regardless of whether it's a barter between Bitcoin and dollars or Bitcoin and groceries. It's
Right. Yeah. I think you should if you think about the transaction with dollars the same way, it's a little more complex than that because dollars obviously are not taxable. So there's only one half of the transaction is taxed. But yeah, I mean, that's the tax system is a great way to enforce like the benefit of using our currency because using a dollar is not a tax event. And that's something that will take a lot of time and energy to change if we want to change it. And it's fundamental to how our tax system is set up. So, yeah. Anyway, sorry, you got me on tangent. I'm going to take someone from this side.
Okay.
Go ahead.
Hi. So hypothetically, what you're saying is that the main use of Bitcoin should be as a store of value in this case, because if you use it as a medium of exchange, then it becomes, you get all these tiny microtransactions that are taxable events.
Oh, have you met my friend Microsoft Excel? I'm just going to, sorry, yeah. And I don't know if it's a question for me. I don't know if I'm responding seriously. But you're saying, like, doesn't this whole issue with the taxes, as I presented it, promote using it as a store of value instead of a medium of exchange? I don't want to take a position on that. That's an incredibly controversial question, especially here. But I do think that we have an uphill battle. This is.
Tries to view it as a store of value versus a medium of exchange.
Well, the classification, well, let me answer that maybe like somewhat simply. The classification of it as a currency versus not a currency isn't necessarily saying that it's not a medium of exchange.
Oh.
Yeah, like whether or not something is a currency is actually a much more in-depth analysis than just whether it's a medium of exchange is one of the things that matters. But I can send you an article if you email me and go ahead.
All right, so hypothetically, what can I tell the IRS if all my Bitcoins sank to the bottom of the ocean in a tragic boating accident?
So there's an interesting problem there. You experience a loss, but but the good part is that you know when it happened. Mm-hmm. Now the biggest problem with losing something is proving when it happened. Like it happened in this tax year. So you have a definitive event. And once you have a definitive event upon you experience the loss, you have to figure out what your tax position is on what type of loss it is. Personal losses are a little complicated, but investment losses are well covered in the tax code, and you can usually find a way to deduct an investment loss. It's
Do you
just
have to prove that it happened, or just say when it happened?
It needs to have an event, identifiable event.
More realistically than boating accident, right? Your private keys were on like a file and then you lost it.
Well, let me give you a better example. Like when the accountants are preparing their adjustment for goodwill, they might be saying, oh, the goodwill has lost a lot of value. This isn't probably a direct analogy, but I think in some senses there's an event that some accountant has defined that has caused the goodwill to lose value. You can just point to that. You don't need, it just needs to be something outside of your own tax motives that you can point to. Does that make sense?
Yeah, kind of. This is more of an event of like you lost the asset, not that the asset went down in value.
Yeah.
Is that?
Yeah, well, it's the same difference. Yeah, yeah. Well, not exactly the same difference, actually.
Is it like if your car blows up, can you?
That's a personal loss. So that's a little
yeah.
different. Were you investing in that car?
Like it was going up in value or something.
Yeah, personal losses are really difficult. They got restricted under tax reform. I'm not the best person to recite that, but all right. Go ahead in the brown sweater.
I'm a little new to this, so this isn't a headline question. I apologize, but how would you handle inheriting cryptocurrency and wanting to sell it and not having good records?
Yeah.
Records on evaluation of restricted.
Yeah. So what happens when you inherit cryptocurrency, and if you don't have good records, is that a problem? Is that fair? Yeah, it is a really big problem. So most tax practitioners would agree that if you do not have a record, if you don't have a clear record of a gift, you then have a lot of issues taking a carryover basis from that gift. And I think you're better off with an inheritance, because with an inheritance you can say there's a step up in basis. So actually, no, I take that back. I think it's fine, because all you need to do is define the ownership of the asset at the time of death, take the position on the value at the time of death, take a position that the basis got stepped up in value. Then the transfer tax, if any, would apply. If it's a $10 million estate, then you get transfer taxes of XYZ over $10 million. And then if there's no transfer taxes, then you receive the full amount, and you don't have your tax basis is stepped up. So with a gift, there's a very serious problem, and this is covered in the FAQs, which is that if you don't know the basis at the time of the gift, you actually have to take a zero basis, which is a bad answer, because preserving basis is part of protecting the fairness of the tax system. So if you receive a gift, do make sure you reach out to the giver and make sure they give you their records. But okay, go ahead.
Yeah. So my question is in collateral-backed loans. You mentioned that it's kind of up in the air, but just maybe this particular scenario, you use a lending service, you offer them several Bitcoin, and then you can get a down payment on a house.
They give you
right?
cash,
In
though.
Cash,
Okay.
Right, and you pay off your loan, your Bitcoin comes back to you, that exact Bitcoin. Has there been a liquidity event?
Now that's a very easy one. So what you're mixing it up a little bit by actually saying you use the money. You didn't. Let's say you just used it to, go on a nice vacation. Okay, so keep it simple. So it's actually taxed if it's a secured loan, and if it's a bona fide loan, it has to pass certain tests and be treated as a loan. Then it can be simply that there's no event for that cryptocurrency. The cryptocurrency has not been sold; it has been pledged. And what happens is, like, people who own stock in private companies who need liquidity, sometimes they'll pledge their stock for cash. Also not a tax event. I mean, usually we are involved in drafting those pledge agreements just to make sure, but they are not generally tax events. But that's assuming that you receive cash. So when you receive property, that's when the question gets really complicated. So, yeah.
Actually, if the company has the financial leasing license, like we are doing so, like we are providing the lending service for customers.
Mm-hmm.
So as long as you have the legal financial leasing license from government, I'm not sure, because I'm from China, it's totally from, the way how they play crypto is totally from America.
Mm-hmm.
But as long as you get the license legally, then you can do the kind of service. But I'm not sure, and then you can avoid tax from that.
In the U.S. tax system, it doesn't matter who the counterparty is. You can be just anybody. Yeah. I could see it being helpful to establish that the counterparty is a respected third-party lender, only because it lends some credibility to the transaction. But I don't know if it makes a difference really for tax.
What are the complications regarding if it's property, say like converting to DAI versus US dollar?
So I'll just make other people's arguments because I don't agree with them. But basically, the idea being, at that point, how do you not have like an exchange event where you? And I think their position, I find it difficult to follow. But their position is that because the tax code does not describe any event like this, that it can't occur. And that's a very, to be honest, the person who said that to me, and I hope they're not watching, was a CPA. And this is really one of the areas where CPAs versus lawyers kind of stand out. Like, just because there's no rule in the tax code that says that you can loan a piece of property for a piece of property, I think that doesn't necessarily mean it's impossible. You know, you have to do a much more in-depth analysis. And you know, one of the things that's so tough here is we're trying to figure out tax before the accountants have figured it out, because most of the time we just look to the so the people who figure out accounting treatment are like 10 times more sophisticated than tax attorneys. I think this is hard for people to understand, because you think that tax attorneys are like the be-all and end-all of money. But no, like the first time I actually interacted with like the academic side of accounting, it blew my mind. They wrote a 50-page memo on an issue that I covered in like 3 pages. So,
follow up to that, because you're talking about this.
Yeah.
Is there a requirement or something around the sophistication of the investor on filing, like in terms of liability on your returns? So a lot of this stuff is very complicated, right? And as an individual investor, you may not be equipped or have that training to understand all the tax law and things like that. Now, obviously, you can go and get an accountant or something like that. But are you forced to do that, or like?
That's a good question. One of the reasons why it's do you have all his question recorded on the live stream? Okay.
It's better if you.
Okay. So his.
Coming through the microphone or not.
Yeah. So his question was, you know, I'm an individual. I'm doing all these complicated transactions. Am I required to get professional advice before filing my return? And I think that's a really important question. It's one that I've been confronting the whole time that I've been doing this. And I used to take the position like, oh no, it can't be that crazy. But then people design crazy stuff. So now it is really that crazy. And it's going to be a fun year. But what you're really pointing at is like something that would be fundamentally unfair, which basically says if people can afford advisors, they can take a more aggressive position. And at its base, that's true. Because what you're doing when you hire an advisor is you're establishing that you're a reasonable person. And like we said, like you have to have a reasonable basis for your tax position, hopefully better than that. And advisors are a way in which you establish that. On the other hand, you can figure out whether it's worth your while. And I think that's the silver lining. And one of the great reasons why we're lucky to have products like ZenLedger around, where you can analyze, you know, you can conduct scenarios, like all those different specific identification scenarios that Pat's developing, is that you can look at and see, oh, well, if I took FIFO, which is what I would do without any professional advice, this is my tax liability. But what if I took a different position? And how much would it be worth to me to explore that with a professional? So these software-based solutions are great in the way that you can at least find out whether it's worth it. So there is a lack of fairness. I do agree.
Like you said, there's a lot of complicated things out there, like NFTs, for example.
At the end of the day, if you're investing in DeFi, yeah, certainly proceed with caution. But you know, there's always a basic position that you can take that's like you can just treat like your investment in MakerDAO as a sale. I hate that answer. I know that you probably all hate that answer. But if you just take the most conservative position, you can at least participate in the market without necessarily having to, hire a professional to do some in-depth analysis.
And there's also things where, like, if there's a smart contract, maybe you're accruing interest every microsecond or something like that.
Yeah. Microsoft Excel. Okay, I have persuaded so many cryptocurrency people that Excel is better than Google Sheets. This is like one of my personal victories. Okay, so you can compile data like really easily with Microsoft Excel. One thing though that you do need to do, which I'm sorry, this advice is too late, is sell it all on December 31 so that you have a clean break at the end of the year and you accumulate the next year. But I mean, if people aren't doing that, if you're not selling as you go, which actually, I'm assuming that you're selling as you go, then you might not do that. But data, volumes of data is no longer a problem in today's day and age. I think people get freaked out by it. But it's probably that you don't understand the data, not that you have too much of it.
Right? Like it's in the contract. No one's performing an action to create that data. How do
you don't receive it in a wallet?
Yeah, say for example that doesn't happen. Say you have.
Well then wait. 2019-24. Use it in your favor.
Okay. There are things like staking, right? So you have to withdraw your stake or something like that too. So.
Well, I don't know what the difference between withdrawing or if you just all you had to do was click a button to withdraw it, then that's not.
Control with the button. That's potential position.
But I don't know. So this comes to a bigger question of like, what if you don't have records? Like this whole dumb thing about time and date. Like who's able to find?
To get the records, right? You have to write a program to extract it from the bot.
Right.
Some of this stuff is not available.
And this is a good question. Like, what are people supposed to do? Because like I think people. I mean, I know that I have searched high and low for 2013, 2014 Bitcoin pricing data on a daily basis, let alone on an hourly basis, or based on a timestamp.
Maybe 2 weeks ago.
They're all
Started
they don't.
2013.
So I've had issues with every source.
With everyone.
What for whatever reason. Okay, so I actually went through this process, and they may have gotten better, but like I went through this process last October, and so the reality is, if you can't get quality information, you have to make best efforts. I mean, the IRS is in the same boat as you. So, anyways, should I do a lot more questions, or should we take a pause and do some?
Let me
lightning talk?
ask the audience before you guys have your questions. We have a lightning round of people. If people would like to make a 1-minute announcement to the audience, I know there is at least one here who would like to do that. Is there anyone, show of hands, who would like to make an announcement to the audience that's a minute or less? Okay, so there will be 2.
Three.
Yeah, that's right. So we only need 2 to 3 minutes for that.
Okay.
So happy to.
May you take three more questions? Yeah.
I have a question. Yeah.
Okay, go ahead, George.
Sure. Thank you. My meetup. What would you say to someone who is who was unable to, get into an arbitrage play that over and over again would have been a 6% gain, but because you had to do that over and over again, it really would not have been a tax savvy strategy, because you would have paid more in capital gains tax just liquidating that initial investment.
So how does the arbitrage work? Lay it out a little bit more slowly for me. So So say it again.
Let's say.
Oh, so you just have low basis. You just have low basis stuff to start with.
A synthetic coin that is supposed to be equivalent to another coin, but in the market it's not, right? But you can continue to trade back and forth between those two coins, even though they don't have parity, but they're supposed to.
Okay.
Right?
Oh, so
that's
what I want to understand.
Yeah. So if there's like a 6% difference, which is a cool little moneymaker, it doesn't make sense, I don't think, in terms of being an American and wanting to engage in that type of arbitrage.
Well, no, because you get basis every time. So the way the tax system works is the second you recognize income, it gets preserved as basis or deducted as there's some event under which you recover the cost. It's not designed to tax you multiple times on the same asset, the same income. It's only supposed to measure increases. So I think you're talking about just transacting back and forth. Sure. Every time you recognize income, you then, unless you start with very low basis property, in which case then you're you do have that problem.
At the same time, if that coin, if the original coin that you sold had a high capital gains because you bought it very low, right? Then you'd have a huge tax hit that would not be applicable if you're only selling it for something that would have a 6% gain.
Sure. So maybe you just buy some to participate in this trade, or I don't know. I don't know. That's an interesting question. I think that's one of the reasons why people have developed all these softwares in the first place, is for people to be able to understand like what the tax implications are of these investment decisions. I mean, it's difficult. So, but I mean, that's actually one of the rare cases where I could say maybe you do want to think about tax first. But generally speaking, tax should not drive, your life choices.
It seems to.
That's
the
one where
issue.
maybe it
really
could.
Seems to, which is why the IRS is winning.
Yeah. Go ahead. Sorry.
Usually by design, IRS can tax only in fiat money. You cannot tax on anything else.
You can't pay tax on any other money.
So
Yeah.
encourage you cannot pay. So this ruling, 2019-24, when they recognize hard fork as ordinary income, as you told, do you see the link there between the hard fork and the fiat money, explicitly set in that ruling, or you as a community should find this link
Well,
to make it taxable as taxable event?
you have to determine the value in dollars, and then you determine the tax. That's piece one. So you, as a taxpayer, are required to do the math, so to speak. The IRS does not tell you what the value is, and that's one of the good things. The other part of your question, though, is like you actually have to come up with the cash. And
My question is,
go ahead.
It becomes a hypothetical event, you say.
Yes.
If I can prove my crypto never meets fiat in any way, never meets anyway. If I can prove that, so IRS treats any crypto if it doesn't meet fiat as taxable. But at the point, IRS cannot tax in crypto. My crypto never meets fiat.
Yeah, they would have trouble seizing your assets if they came after you, I
Yes,
guess.
yes.
Okay,
I have.
but they could seize your assets. They have seized
In which way?
cryptocurrency.
If crypto never meets fiat system.
Well, no, they have seized. So they go to your house. They take your computer. I mean, literally, that's what happens.
Okay.
Yeah.
Imagine if they cannot find the cold storage.
Yeah.
Cold storage can be anywhere, like
Okay.
on the bottom of the ocean.
Yeah, but I mean, if you want to live in the United States, you kind of have to like deal with the fact that
My question is,
eventually they would.
isn't this ruling is only about that they explicitly set forth that any hard fork would meet fiat money in any way through crypto exchange?
No,
for
it doesn't
example.
have to.
Because otherwise there is no logic to IRS to tax something if it's not with the fiat connected in some way.
So let me tell you where that argument does work. If you have a cryptocurrency that doesn't have any determinable value in dollars,
Yes, correct.
then you potentially could be able to argue that it has no relevance to the U.S. tax system. The second that somebody is transacting in dollars with it, anyone, anywhere, in a measurable amount,
Yes.
then it has value and then it's taxable.
Yes, in fiat money, in US dollars.
Yeah,
But
anyone
if
else.
not-
So anyone else can screw you.
Okay, so essentially now IRS sees that any crypto now is connected with the fiat money.
It's convertible
Convertible,
currency,
yes,
yeah.
it means.
Yeah.
So it's,
So, yeah, you're right, but it's more abstract than just your own personal transacting in dollars. It's more like if anyone ever has given it dollar value. That's what's more. Sorry, I forgot to repeat this question. I'm bad with that.
thank you.
I'm not very respectful of live streams. Anyways, okay, one more. Who was first? You think it was, oh, you can talk after. You can talk after. Okay, go ahead.
I have a couple of questions. So first one is about the wash sale rule. So you said if it happens 31st of December and then buying it the 1st of January, it's possible to do so. But can you do it within the year? So 1st of December you sell it, and then you just buy it again. Is that considered as a loss?
So, sorry.
So instead of doing the wash sale rule the 31st of December and then buying it again on the 1st of January, can you just
Oh,
say?
yeah, it doesn't matter when. It doesn't, well, you want to make sure the sale is in the correct year to get your loss, but you don't need, it doesn't matter when you repurchase it. I mean, don't repurchase it 1 millisecond later, because that would be too close.
Got
But it doesn't matter. There's no rule. Like, the IRS does not
Right.
have a rule, so
Got it.
you can do whatever you like.
Now, the other question is about the like-kind exchange.
Yes.
So, let's say that you have massive losses and you already filed your taxes. when will it be decided whether you can do an amendment, and if you can do it in order to get a refund, when would be the last time to do so, and would you need opinion letter in order to be able to?
Yeah, so generally the way it works is so your tax is due an individual like April 15th. The payment of your taxes on that date starts a statute of limitations that applies in the IRS's favor. And so when you pay your taxes on April 15th, you basically said, IRS, I only have 3 years to spend. And so 3 years from that date is the last day you can file an amended return. Does that answer your question?
Right, but so when will it be decided whether like an exchange?
No one's going to tell you. Oh, come on. If the IRS decides it's okay, they're not going to tell you. Then you'll never hear it. If they decide it's not okay, you'll hear it.
Got it. But will you still need, for example, an opinion letter in order to? So how would you?
I think it's a risky position. So the rules. Okay, I disagree with the people who prepare these like form opinions. I think it's very complicated. I think you have to really think about which two pairs you're trading in before you take a position. And the view that I subscribe to is that it should be treated like an intangible, like kind of exchange. And there's this principle that you look at the underlying rights. So if you're transacting between Bitcoin and Litecoin, their underlying rights are not that dissimilar. But if you're transacting between Bitcoin and Zcash, for example, would be also not that dissimilar. But if you're transacting with like a staking token, like Cosmos Atoms, you could potentially argue that those are like distinct in terms of their rights. So I think it's a really difficult position to take, and so that's why it is better if you can get some advice from a professional to talk about like why they are similar. The IRS has been very difficult about providing guidance for like kind of exchanges, so it's a difficult thing to even provide an opinion letter on. But even having a bad opinion letter is better than none at all. So, but use your gut. If you're paying for a $2,000 one for millions of dollars in losses, you probably should think about whether you're going the right way. So, anyway, okay, all right.
Anything you want to say in closing?
No, but thank you very much for having me. It's been great visiting. Thanks for. I sent an email saying that I was going to be here at 7:15. I'm very proud to be here at 7:14. So, but I don't think you got the email. So I'm glad that I was able to make it, and thank you very much for having me.
I'd like to invite Richard up from a blockchain project called Beat, and he has been volunteering along with some other people, Jeff, who's here, and Jerry. They have been coming to the Bitcoin meetups for many years now. But Richard is helping me with the event, and so he would like to announce his name.
Sure, yeah, so I'm actually here for two things. One is the Beat project, which I'm co-founder and CEO of. So if you have time, check it out. It's an alternative to Ethereum and EOS. But the other thing that I'm currently working on is a blockchain podcast. It's called the Blockchain Debate Podcast. And so basically the future of this industry can unfold in many different ways. And then for each way, there seems to be a group of fanatics that firmly believes in it. So I think there's a lot of value in bringing in those fanatics, have them talk to each other, and then for the rest of us to listen to them and make up our minds by hearing their arguments. So our Twitter is @blockdebate, and you can find us on Apple Podcast or Spotify Podcast. It's called the Blockchain Debate Podcast. That's it. Thank you.
Who else wanted to make a lightning announcement? Please come on. Go ahead and stand where he was standing. Yeah, there you go.
It's a good place.
Let's go, yeah.
Okay, hey, I'm Juan. I'm from Velvet Tax. We, as you guys know, well, maybe some of you know this, around the world, countries like UK, Germany, Japan, they have a tax return free system. In the US, we have to file our taxes, and you could argue a big portion of this is because there's a lot of lobbying coming from the side of services that want to keep us filing our taxes. So this is where the angle that we're trying to come from. Our mission is to allow you to do your Bitcoin taxes in an easy way. We have a 3-step process. We're mainly working with individuals who have any kind of mining, spending, and exchange transactions. As Pat mentioned from ZenLedger, a lot of the exchanges have very different ways of downloading your transaction data and all this stuff. So we've been putting together something that makes this process quick and easy for you. So if you want to check it out, we're at velvettax.com. Thanks.
So I just want to say thank you to our speakers today, and thanks for the volunteers who made this happen, and for Plug and Play, which has been the home of the Silicon Valley Bitcoin meetup ever since its beginning, which is either 2011 or 2012, depending on what Roger Ver will tell you. So thank you for joining, and great. Thank you. Thank you.
Yes.